Overview of short-run and long-run cost of production. Accounting profit versus economic profit. Short-run production, TP, AP and MP, that is total product, average product and marginal product. Short-run total cost, that is total cost, total fixed cost, total variable cost and marginal cost. Short-run average cost, that is average cost, AFC, that is average fixed cost and average variable cost. And lastly, long-run total cost curves. Economists distinguish between two types of cost, accounting cost and economic cost. Accounting costs include only explicit cost. Accounting costs are essential to any business. Every business owner must know the exact amount of money coming in and going out. Accounting costs are reported on official company ledgers. Economic costs include both explicit and implicit costs. The actual earning power of a firm in the long run is more represented by economic profit than accounting profit. If a company has an asset, an orange grove, for example, and uses an economic cost analysis to determine if it would be better to maintain and harvest the orange grove or lease it to another company to do the work, finding the differences in cost between the two options is the benefit of using an economic cost analysis. Economic costs are important for determining long-range business strategy. Economic costs are critical to determining if there are lost opportunities for revenue that organizations miss by choosing one strategy over another. At its simplest levels, it is a way of determining how to use a company's cash and resources to create the biggest profit. Accounting profit and economic profit. Actual earning power of a firm in the long term is represented by economic profit than accounting profit. Accounting profit is total revenue minus total cost, that is, the explicit cost as per book of accounts, and economic cost is the total revenue minus total cost minus implicit cost, that is, opportunity cost of alternative use of assets deployed. So economic cost includes both implicit and explicit cost, whereas accounting profit includes only explicit costs. Example, suppose Jade owns and manages his own restaurant. Here his total revenue is $400,000, worker salaries is $175,000, material expenses is $25,000, foregone salary or given up salary is $40,000. Calculate Jade's accounting profit, calculate Jade's economic profit. So his accounting profit is total revenue minus total cost, which is the explicit cost, which is paid in terms of money. So total revenue is $400,000. So total cost which he pays in terms of money are worker salaries, that is $175,000 plus material expenses $25,000. So total $200,000 is his explicit cost. So the accounting profit is $400,000 minus $200,000 is $200,000. Now economic profit, which is total revenue minus total cost, which is explicit cost, minus opportunity cost, it is implicit cost. So here is implicit cost is the foregone salary or given up salary of $40,000. So economic profit is $200,000, which I have already calculated. That is total revenue minus total cost is the accounting profit minus $40,000, that is the opportunity cost, now which equals to $160,000 is his economic profit. Short-run production. In the short run, firm's plant capacity is fixed. Only variable inputs like labor, raw materials can be changed to increase production. In the short run, we define three terms to explain labor-output relationship given fixed plant capacity: total product, marginal product, and average product. Total product is the total quantity or total output of a particular good or service produced in a given period. It is an output rate, that is the number of units produced per unit of time, for example, per hour, day, or week. Total product changes as the quantity of labor employed increases. In the total product curve, all points above the curve is unattainable. All points below the curve are attainable but not efficient as they use more labor than is necessary to produce a given output. Only the product on the total product curve are efficient. Marginal product. Marginal product is the additional product resulting from increasing input by 1 unit, which is calculated by change in total output over change in labor input. Average product is called the labor productivity is output per unit of labor input. Average product is calculated by total product over units of labor. Law of diminishing marginal returns in the short run. In the short run, as successive units of a variable input, say labor, are added to a fixed input, say capital, the marginal product of the variable input eventually declines. In short run, diminishing returns will occur sooner or later. Total product eventually rise at a diminishing rate, reach a maximum and then decline, which you can see in the figure. Relationship between total product and marginal product. So when TP is increasing and reaches point P in the figure, that is the point of inflection, that is MP is also increasing, reaches maximum. When TP is increasing at a decreasing rate and reaches maximum point at M, MP is 0. When TP begins to decline, MP becomes negative. Relation between average product AP and marginal product MP. Both MP and AP initially increase and then decrease due to the law of diminishing marginal returns. If MP is greater than AP, AP increases. MP is equal to AP when AP is at its maximum. MP is less than AP, AP also starts to fall. Therefore, both AP and MP fall, but MP becomes negative and AP remains positive. MP curve is steeper than AP, which you can see in the figure. Short-run production cost, short-run total costs. Total fixed cost, those costs that do not vary with changes in output. Fixed costs are associated with the very existence of firm's plant and therefore must be paid even if its output is 0. Such costs as rental payments, interest on the firm's debt, a portion of depreciation on equipment and building, and insurance premiums are generally fixed costs. The firm cannot avoid paying fixed costs in the short run. Total variable costs, that is TVC, are those costs that change with the level of output. They include payments for materials, fuel, power, transportation services, most labor, and similar variable resources. Total cost is sum of fixed cost and variable cost at each level of output. So total cost is TFC plus TVC. Total costs. Total cost of a firm are the sum of minimum explicit and implicit costs, including normal profits incurred by a firm in producing a specified level of output given technology and set of input prices. Explicit costs are out-of-pocket expenses of the firm, costs that are paid in money like wages of labor, rent of land or building, purchase of machinery, etc. Implicit cost is subtle in nature. It is the opportunity cost of assets or time deployed. For example, if the firm owns the land or building in which it operates, it does not pay rent. If the firm owner performed labor in his own firm, he may not pay himself any wages. But the use of these factors does have an opportunity cost. The firm could have rented out its land and building to another firm. The firm owner could have found employment that did pay him wages, etc. This opportunity cost is also included in the total cost of production. Thus, total cost includes both explicit and implicit costs. Implicit cost is the implicit cost or opportunity cost of entrepreneurship. This is called normal profit. Normal profit is the minimum level for profit required to keep the entrepreneur in the current firm. If the entrepreneur does not receive at least the normal profit, he will shut the firm down for alternative activity. Thus, normal profits are also a part of the total cost. Production function and TC curve. The production function gets flatter because of diminishing marginal product as the number of workers increases. The total cost curve gets steeper as cost increases because of diminishing marginal returns as the quantity of output increases. You can see the difference between the total production curve and the total cost curve. Short-run total cost curves. TFC curve is a horizontal straight line parallel to x-axis as it remains constant at all levels of output. TC and TVC are inversely S-shaped because they rise initially at the decreasing rate, then at a constant rate, and then at an increasing rate because of law of diminishing returns of variable proportions. TC and TVC are parallel to each other and the constant vertical distance between them represent TFC. At zero output, TC is equal to TFC as there is no variable cost at zero level of output. The vertical distance between the TFC curve and the TC curve is equal to TVC. Short-run marginal cost, that is MC, and per unit or average cost, AC. Marginal cost is an addition to total cost when one more unit of output is produced. The marginal cost curve is generally upward sloping because diminishing marginal returns implies that additional units are more costly to produce. Average fixed cost refers to the fixed cost of production per unit. It is calculated by dividing the TFC by total output Q. AFC is equal to TFC over Q. Average variable cost or AVC refers to the per unit variable short-run cost of production. That is how much one unit of output costs. It is calculated by dividing TVC by total output. AVC is equal to TVC over Q. AVC, average total cost and average cost, refer to the per unit total cost of production. It is calculated by dividing TC by total output. That is AC is equal to TC over Q. You can see all the average total cost curves, ATC, AVC, AFC. The AFC falls continuously as output increases because given amount of fixed costs is spread over the larger and larger output. It is rectangular hyperbola and never touches either of the axes. The AC curve lies above the AVC curve because AC at all levels of output includes both AVC and AFC and is typically U-shaped. The AVC curve is also typically U-shaped. AVC initially falls because of increasing marginal returns but then rises because of diminishing marginal returns. As output increases, the gap between AC and AVC curves decreases but they never intersect each other. This happens because the vertical distance between them is AFC, which can never be zero. The marginal cost curve is upward sloping and U-shaped. MC falls till it reaches its minimum point and thereafter it starts rising because of law of diminishing returns. Relation of MC curve with ATC and AVC curve. The marginal cost curve cuts through the average cost ATC curve and the AVC curve at their minimum points. When MC is below average total cost, ATC falls. When MC is above average total cost, ATC rises. Similarly, when MC is below average variable cost, AVC falls. When MC is above average variable cost, AVC rises. No such relationship exists between the MC curve and the AFC curve because the two are not related. Marginal cost includes only those costs that change with output, and fixed costs by definition are those that are independent of output. The relationship between productivity curves and cost curves. The marginal cost curve and the average variable cost curve in B are mirror images of the marginal product and average product curves in A. Assuming that labor is the only variable input and its price, the wage rate is constant, then when MP is rising, MC is falling. And when MP is falling, MC is rising. Under the same assumptions, when AP is rising, AVC is falling, and when AP is falling, AVC is rising. Shift of cost curves. Changes in either resource prices or technology causes costs to change and cost curve to shift. Revenue of the firm. The total revenue earned by the firm is simply the quantity of the output the firm sells multiplied by the price the firm receives for each unit sold, that is TR is equal to P times Q. The total revenue curve is an upward sloping curve through the origin with P. If P is constant, then the curve is a straight line. Average revenue is the per unit total revenue, which is nothing but the price the firm receives for each unit sold. So AR is equal to P, that is price. So AR equals P, that is average revenue equals price that the consumer pays per unit of output. Since the consumer will be willing to buy each successive unit of output only at a lower price, the average revenue will fall for each successive unit sold. Average revenue curve is nothing but the consumer's demand curve. AR curve is equal to D curve or the demand curve. Marginal revenue of the firm is how the total revenue changes for each incremental unit sold. So MR is calculated by changing TR over change in Q. The slope of the total revenue curve is marginal revenue. If price is constant, MR will also be constant. If the price falls as the quantity sold increases, the marginal revenue will also fall as the quantity increases. Average cost as firm's profit margin. Average cost tells a firm whether it can earn profit given the current price in the market. If we divide profit by the quantity of output produced, we get average profit, also known as the firm's profit margin. Average profit equals average revenue or price minus average cost. If the market price is above average cost, then there is average profit and thus total profit will be positive. If the price is below average cost, then profits will be negative. Comparing marginal revenue and marginal cost. Profit maximizing output for firm, MR is equal to MC. We can compare this marginal cost of producing an additional unit with the marginal revenue gained by selling that additional unit to reveal whether the additional unit is adding to total profit or not. Thus, marginal cost helps producers understand how increasing or decreasing production affects profit. Long-run cost production curves. In the long run, an industry and its individual firms can undertake all desired resource adjustments. That is, they can change the amount of all inputs used, both fixed and variable. The firm can alter its plant capacity. The long-run average total cost curve is made up of segments of the short-run cost curve ATC1, ATC2, etc. of the various size plants from which the firm might choose. The vertical lines perpendicular to the output axis indicate the outputs at which the firm should change plant size to realize the lowest attainable average total cost of production. These are the outputs at which the per unit cost for a larger plant drop below those for the current smaller plant. Most firms have U-shaped long-run average total cost curves reflecting economies and then diseconomies of scale. Economies of scale are the consequences of greater specialization of labor and management, more efficient capital equipment, and the spreading of short-term cost, startup cost over more units of output. Diseconomies of scale are caused by the problem of coordination and communication that arise in large firms. Minimum efficient scale or MES is the lowest level of output at which a firm's long-run average total cost is at a minimum.